Why are the gas companies pouring billions into electric vehicle charging? December 25, 2022. Oil companies are pouring huge sums into the EV charging industry. And their interest in public charging goes far beyond installing a few chargers at their gas stations. Oil majors including BP, Shell and Total have been buying up companies at all points along the charging value chain. From equipment manufacturers to network operators to makers of solutions. Those nebulous mixes of product and service that make the whole system work better. Why is big oil going big on charging? The optimist sees the obvious motivation. These companies want to do the right thing for the planet and for themselves. Transitioning to a new and cleaner technology. The skeptic suspects that their real aim is to cripple that new technology. If not by shutting down innovators in the field, then by controlling the market. And making sure that public EV charging is at least as expensive as pumping gas. And less convenient. Public chargers, some of which are operated by oil companies, always seem to be out of order. Coincidence? Arkady Sosinov, the founder and CEO of FreeWire Technologies, is in as good a position as anyone to understand the relationship between oil and charging. His company is working with several major oil retailers, including Chevron, Phillips 66 and service station chain Parkland, to help them deploy fast charging at their gas stations. Sosinov recently conducted a webinar for Charged, which is well worth watching in its entirety. In a nutshell, FreeWire's value prop has to do with the fact that DC fast charging requires gobs of power. And many sites simply don't have the required capacity on their grid connections. FreeWire's Boost charger uses an integrated battery as a buffer to deliver high power output from an existing low-voltage utility service. This enables fast charging to be installed at sites where it would otherwise be prohibitively expensive. Or impossible, sites like convenience stores and gas stations. When it comes to big oil's motivation for charging into charging, Mr. Sosinov sees no nefarious conspiracy. But he does offer an interesting insight. The dealers in dinosaur wine have been printing money over the past couple of years, and they arguably have no good place to put it. What's the only sector of the S&P 500 that overperformed in 2022? Energy. As of the date of our recent webinar, the S&P 500 was down 19% for the year. But the S&P Energy Index was up 57%. Buoyed by $80 per barrel crude oil. Chevron and Exxon alone printed $200 billion in EBITDA earnings in the last 3 quarters. Says Sosinov. These are record margins, record profits. But guess what? They're not spending money building new oil rigs or drilling new wells. And that's a self-fulfilling prophecy. If they're not drilling new wells, it's going to keep the price of oil high for an extended period of time. So they're going to see these profit margins for years to come. Where are they going to spend all that cash? Some of it is sloshing around in the EV infrastructure industry. Sosinov lists just a few recent announcements. Plans to invest billions of dollars. And to build tens of thousands of charging stations. As readers of industry media outlets like oilprice.com know, savvy industry observers don't have their heads in the sand, at least not very deep. They know that their industry is facing an existential threat. For the oil leviathans, investing a few of their billions in EV charging is the only logical thing to do. Sosinov also believes that quick service restaurants will soon launch another wave of EV share investment. As soon as the Starbucks, the 7-Elevens and the McDonald's start offering charging en masse, you're going to see charging rollouts all over the country. Right now, Chevron, Phillips, BP and Shell, they're competing against each other. But in this new landscape, they'll be competing with Starbucks and McDonald's, not for dispensing actual fuel or electrons, but for the other share of the wallet. When a person charges their vehicle, are they spending on car washes and Red Bull in a convenience store? Or on a latte and a muffin at Starbucks? There's a new gold rush on, and FreeWire will be happily selling picks and shovels to the miners. Source reposted and summarized from Charles Morris at Avanex. My take: the gas companies see the writing on the wall and that their current business model will soon be gone. Cathie Wood has a strongly bullish outlook on Tesla. December 25, 2022. Cathie Wood's ARK uploaded $10.6 million worth of Tesla shares this week alone, signaling a strong bullish outlook on the company. The fund continued its series of purchases, backing up its portfolio with Tesla shares. the purchase of which was activated in October. Tesla shares have lost about 65% in value since the beginning of the year. While this scares some investors, Cathie Wood, using a strategy of buying shares low and selling them high, continues to buy tens of millions of dollars worth of Tesla shares. Wood's ARK Innovation ETF ARK Invest ARKK managed to buy 20,458 Tesla shares on Friday. The firm's daily trading report showed the purchase is valued at $2.52 million, based on Friday's closing price of $123.15. The purchase followed after loading on Wednesday. Thus, Wood's funds were actively buying Tesla shares in all trading sessions of the week, except for Thursday. During this week, ARK Innovation, through its three flagship funds, ARK Innovation ETF, ARK Autonomous Technology and Robotics ETF, and ARK Next Generation Internet ETF, made the following purchases: Monday 27,494 shares, valued at $4.1 million. Tuesday 19,125 shares, valued at $2.64 million. Wednesday 9,952 shares, valued at $1.37 million. Friday 20,458 shares, valued at $2.52 million. The combined purchases amounted to 77,029 shares with an estimated total value of $10.63 million. Last week there were also two purchases totaling 111,842 shares, worth $17.42 million. ARK Investment Management Funds purchased more than 522,000 shares of Tesla since October 3, when they started their latest buying streak, according to ARK trading data, as Wood is in a hurry to capitalize on the stock in the future. Source reposted and summarized from Eva Fox at Tasmanian. My take: all the big boys are getting themselves into position for the big Tesla stock bounce back in 2023. South Korea's local governments battle to host Tesla Gigafactory. December 25, 2022. Tesla is always looking to build the next Gigafactory, and South Korea is one of the most likely destinations. The Asian country's municipal governments are already angling to be the host after Tesla revealed its plans to site another production plant in Asia. South Korea is a strong contender thanks to being home to some of the biggest EV battery and cell makers like LG Energy Solution and L&F Company. Another advantage is the country has free trade agreements with Tesla's main markets, meaning export tariffs will be at a minimum. The country's Ministry of Trade, Industry, and Energy has concluded gathering information on potential sites from all 17 leading local authorities. As reported by the Korean Economic Daily, the data will be forwarded to Tesla before the year ends. The local government authorities are luring Tesla to make their regions more competitive. In addition, a Tesla Gigafactory will likely attract more high-profile investments from the global business community. The regions have been touting their edge, including closeness to ports, abundant power supply, steel makers, battery manufacturers, etc. Tesla currently runs 2 gigafactories in the US and 1 each in Germany and China. Hosting a gigafactory has become a race between countries and states, competing with incentives such as tax breaks. Source reposted and summarized from Richard Walker at Drive Tesla Canada. My take: everyone wants to host the next gigafactory. Come on Elon, I thought you had your sights set on Canada. Tesla sparks high demand in US with discounts. December 25, 2022. Tesla is selling off cars that have been used for showrooms and test drives in the US. This confirms the highest demand for the manufacturer's vehicles at the end of the year, which was largely due to current generous discounts. Tesla began selling demo and test drive vehicles in the US through the end of 2022. Thus, the company's cars, which are on the balance sheet of individual stores, can be sold to customers if they so desire, while receiving all the recent bonuses launched by the manufacturer. The move comes after Tesla offered a discount on its Model 3 and Model Y in North America on Thursday. According to its website, the manufacturer is offering a $7,500 rebate in the US and a $5,000 rebate in Canada if the car is delivered before the end of the year. Plus, Tesla is offering 10,000 miles of free charging on its superchargers. Apparently, the number of orders for Tesla cars is now through the roof. Several of Tesla's customers told Tasmanian that they had to wait on the line to connect with a company representative to complete an order for more than an hour. Reports that stores are selling their demo cars further confirm that demand is insane right now. Similar sales rebates from Tesla have occurred in all of its major markets, the US, China, and Europe. Apparently, the manufacturer has set its sights on a very aggressive Q4 by selling all available cars. Tesla was able to significantly increase vehicle production in Q3 and Q4 this year. In addition to the growth in production capacity of Giga Shanghai, Giga Berlin and Giga Texas are also growing and making a significant contribution to the number of cars produced. Source reposted and summarized from Eva Fox at Tasmanian. My take: you know you are onto something when your customers will even buy your demo cars.